Matthew, just in simple English, a Capitex rating is at junk, in line with the sovereign.
It's in speculative grade. We don't use the word junk,
right.
Obviously, but yeah, it's in line with the sovereign. There's different factors, obviously, but we would see that the sovereign risk is an overwhelming risk for the bank.
Right. Why did S&P Global feel it was important to come out with a statement following the Viceroy report?
It's purely market interest. So when the report came out, within kind of a few hours, I had a dozen or so calls from investors that we know quite well in the market. They wanted us to comment on something, and the rating agency cannot comment unless we do some sort of public announcement, and that's why we chose to do a bulletin, and then it allows us the freedom to talk to people, to give our views on stuff.
So I take it you've had a glimpse of some of the things that was said in the report. Does S&P Global agree with some of the things that were said, or like National Treasury and the Reserve Bank and many fund managers, you dismiss it as completely inaccurate?
We don't dismiss anything. I mean, it's hard to say there isn't anything that may or may not be true, but I guess the easiest way to say it, from the data that we saw and from the information that we read, there was nothing that we viewed that would change the rating on Capitec. So the litigation stuff that we read, we were aware of it, we have our own opinion on it. The numbers that we had, we couldn't necessarily reconcile. We have our own numbers, we have access to management and their numbers. So for us, there was nothing in the report that was particularly new or particularly interesting for us to change the rating.
All right. So the accusation in the report that Capitec is essentially on the brinks of bankruptcy because of, amongst other things, the macroeconomic headwinds being very difficult for the banking sector, you don't agree with?
We don't agree with that, no. We think the capital position is sound. We think the provisioning they have is robust. They're liquid, they're funding stable, they've got good revenue diversification. So we think no, they're far away from solvency or curatorship issues.
But what's your take on the micro-lending sector as a whole here in South Africa and Capitec's position in it?
I think the micro-lending sector is a mixed bag. It's very hard to tar everyone with the same brush, and we're talking generalisations. Capitec is a fully functioning, regulated institution that has a diverse revenue stream. There aren't many micro-lenders in the market that have that. And we think in terms of the practices that they have, they've obviously gone through regulation. There's been people over much better scrutiny than we have taking a view on it, and it seems to be fine from their point of view. And then as long as it doesn't affect their business stability, then that's okay with us.
Many have questions whether it's a sustainable business model, that this micro-lending space, although Capitec, yes, does take deposits, particularly when it relates to the predatory fees. Mm-hmm. I mean, what's your take on the high level of fees that Capitec charges, which the report claims is the highest globally amongst high-risk lenders in its field?
Yeah, I don't think we have a particular opinion on whether the fees are too high or particularly predatory. I think that the fact that they're getting 100 or so thousand transactional accounts a month would prove that there is a business model that is sustainable. In terms of global fees, I'm not sure that's correct. I think I've seen much more aggressive fees and interest income in other emerging markets, and in fact probably some developed markets in and around Europe.
Matthew, I mean, just to broaden this conversation a little bit, as a Londoner, as someone who is not from this country, there's this short selling craze that has hit South African markets that many have said that our investors or our companies or our institutions are not really familiar with it. Is this something that you have experienced abroad? I think
London, New York are a bit more exposed to it, or historically are a bit more aware of it, and I think that they wouldn't react in exactly the same way. I think that, I'll give you an example. So by the time I'd read the report in detail, the shares had already gone down like a significant amount.
Some 25% or something.
I think that's really proof of that the people were, obviously Viceroy had a big impact with Steinhoff. They used that name in order to make an impact elsewhere. I think that caused jumpiness amongst investors. Would that have happened in London, New York? Generally it's speculation, but I'd probably say not to the extent it did. It did surprise me how quickly it went down.
Mm. And just in terms of the general banking sector, without making you say anything that you can't say, there's really been renewed optimism in our banking sector since the outcome of the ANC elective conference. Can you comment at all as to the renewed optimism we've seen towards South Africa and the outlook for banks in this environment?
Yep, I can comment for a long time on that one. I think South African banks are solid institutions. In fact, if you were to remove the sovereign risk of the South African banks, they would be a much higher rating level. We think they're solidly capitalised. We think there isn't the external funding risk that South African banks have that other EM banks have. We think they have good profitability. They're well managed. And we think on the back of the increased confidence, which is questionable, like we've seen some investor confidence with the rand, but has that come through in true sentiment of capital formation increasing? Are investors really putting money into real estate? Are household spending again? When that comes through, we think the banks will benefit from it, but I don't think hasn't quite come through yet, I don't think.
And the risks, just to balance that conversation, what do you still see as the risks for our banking sector?
Short-term or medium-term wholesale concentrated funds from the banks. It's an idiosyncratic risk for each one of the major banks. We also see household leverage is fairly high for an emerging market. So if there was a big swing up in interest rates, there may be some issues in terms of the credit losses. SOE exposure, would probably see that as a risk. So they're kind of the three major risks that I would see today for the South African banks.
On the SOE exposure, though, I'm sure the moves that we've seen in Eskom has inspired some confidence, as we do know a lot of our banks are exposed to Eskom debt.
Yeah, I mean, the loan books weren't stuffed full of SOE debt for the banks, which is good. Obviously, there were some derivative positions. There's obviously a bit more exposure now to Eskom that we've seen. But I think that Eskom sorting their funding or immediate liquidity risk it's been a big avoidance of anti-sentiment, I would say. There was a potential huge risk there that I think that we've kind of dodged that bullet. And I think the South African banks supporting them, pushing through those governance changes is very good for this country.